When a taxpayer files bankruptcy, the IRS usually has to hit pause. That pause is the automatic stay. It generally stops IRS assessment and collection activity while the case is pending. The stay lasts until the court lifts it or the bankruptcy ends and debts are handled. On the EA exam, watch for questions asking what actions must stop immediately once the petition is filed. Automatic stay is broad, but think of it as stopping the IRS from moving forward, not erasing the debt by itself. Collection actions like levies and enforced collection generally must stop. Assessment activity is also generally paused. The key exam move is separating stopped for now from gone forever. Discharge is what can eliminate legal enforceability, and that depends on meeting specific timing and conduct rules. For income taxes, dischargeability often comes down to 3 timing tests. You'll hear them as the 3-year, 2-year, and 240-day rules. The return's due date must be at least 3 years before the bankruptcy filing. The return must have been filed at least 2 years before filing bankruptcy. And the assessment must be at least 240 days old. Miss anyone, and the tax usually survives. Even if the timing works, conduct can kill discharge. If the taxpayer committed tax evasion or the return was fraudulent or frivolous, bankruptcy won't wipe that income tax away. On the EA exam, this is the trap. Students memorize the dates but ignore the behavior facts. If the question hints at hiding income, fake documents, or intentional evasion, assume non-dischargeable. Bankruptcy also affects the IRS collection clock. Normally, the IRS has 10 years from assessment to collect, but when bankruptcy is filed, that collection statute is suspended while the petition is pending. Then the IRS gets extra time after the case ends, commonly an additional 6 months. So bankruptcy doesn't run out the clock. It usually extends the time the IRS has to collect. Here's the practical takeaway. Bankruptcy creates 2 separate effects you must track. 1. The automatic stay pauses IRS actions right now. 2. The CSED is told, meaning the countdown stops, during the bankruptcy, plus extra time after. On exam questions, they'll give you an assessment date and a bankruptcy timeline and ask what happens to collection. Your answer? Collection pauses and the deadline moves out. Brianna filed her 2020 return on April 15, 2021, owing $6,250. The IRS assessment date on her transcript is April 25, 2021, when the return was processed. She didn't pay, and she ignored IRS notices. What is the collection statute expiration date, the CSED, on this tax debt? Think about which date starts the 10-year clock. The correct answer is April 25, 2031. The IRS generally has 10 years from the date of assessment to collect, not from the filing date or the due date. The tempting wrong answer is April 15, 2031, because students anchor on the return due date. But the transcript assessment date, April 25, 2021, is what controls here. Income tax debt that's forgiven in bankruptcy has to meet certain conditions. Which statement is not correct? One option says no evasion or fraudulent or frivolous return. Another says the return due date must be at least 3 years before bankruptcy. Another says the assessment must be at least 365 days old. And another says the return must have been filed at least 2 years ago. Think about it. The incorrect statement is the one saying the assessment must be at least 365 days old. The general discharge timing rule is 240 days, not 365. The tempting part is that 1 year sounds like a reasonable rule of thumb, but the EA exam loves the exact number. 240 days for the assessment timing test, alongside the 3-year and 2-year rules.